Hi, welcome to the second part of our training on volatility index trading. We are on the third topic, which is important PDRs that you have to know. We've treated other blocks, we treated proportion blocks, treated trend lines, treated optimum trade entries, brief introduction to all these things. Now I'm going to explain mitigation blocks and breakers and what is the difference. So to start with, I will just draw some things, and I hope this is recording. All right. Difference between breakers and other blocks. Breakers and mitigation blocks. Sorry. Good. This is one. Now I'm going to represent the second one. Okay. There is a very very small difference between these two. They look alike, but they are different. Here we have just mitigation, right? Mitigation means the the markets. Let me know. I'm trying my best not to use forex terms here. The algorithm, let me put it that way, tries to deliver fair price by trying to go back to some areas to in order for traders who actually know what they do, what they are doing, to be able to either open new trades or close losing positions, okay, or even to add more positions to their already running positions. The difference between these two is that one involves stop hunting while the other does not involve stop hunting. And what I mean by that is, if you look at the beginning of these two trends, you are going to see something, and that is what we have here as our self buy side liquidity. Okay, so we have a buy side liquidity here, we also have a buy side liquidity here. But what makes these two buy side liquidity different is what defines these two terms, which are the proportion, the mitigation blocks, and the breaker blocks. So here we have our mitigation block, and here we have our breaker. Okay. So I'm taking my time to explain this because a lot of people miss these two things. And then we have our breaker block. Okay. Now what differentiates these two is that here our buy side liquidity was left untouched before price took out this low and then came back for a retracement, right? Sometimes they come a little bit higher into this into premium. This is we are considering a bearish scenario here, a bearish market condition. We come a little bit maybe into 0.79 optimum trade entry, and sometimes they just stop here. It's still mitigation, okay? But here, what can you see? You can see that our buy side liquidity was taken out before price broke structure to the downside. We broke structure to the downside here, we broke structure to the downside here, and we came for retest here, we came for retest here. But the difference is that here the buy side liquidity was not taken. Here we took the buy side liquidity and immediately we ran away, breaking market structure. Okay, so that is the difference. So this, when price comes back into the last candle that sold before market bought into the buy side liquidity, that particular candle is your breaker block. Okay, some people like to say the candle that trades back into the last down close candle is your breaker block. Well, I don't think that's what I learned. So mitigation also is the same candle, but here we do not have stop hunting of your buy side liquidity or buy stop or buy stop. The same scenario when we are in a selling or we have a sell market condition, a bullish market condition. So let me just quickly draw that. We have something like this, and then we have something like this. Now, before I finish drawing this, what is this? This is a mitigation, obviously, because the sell stop will not be hunted. Now, the sell stop is here in form of sell side liquidity. Okay, so the sell side liquidity was not hunted before price took out this bullish market structure and then came for a retracement. This is mitigation. But in a situation where price took out the sell side liquidity before going to take out the swing high, right? And that involves the stop hunting, and that becomes a breaker block. So that is the difference. So I've explained the difference between breakers and mitigation. They are not the same, even though the market structure looks the same. There's a very popular image of ICT where they talk about the ICT patterns. This is one of the patterns, and this is just what it means. Okay, so I'll show you a typical example of mitigation. As you can see, this is a swing low right here. This is a swing low, at least before the massive rally to the upside. 70992.46 is a swing low, and then which other swing low can we spot here? Okay, I can see another swing low. Another swing low is all the way right there. Okay, now can I also point a swing high? I can also point a swing high right here. Here is a swing high. Here is a swing high as well, and as you can see, before price came all the way to this level, we did not hunt this low, and as well this low was also not hunted in any way by creating a new low. It might be with just a single candle or a single wick that will take out this low before price goes up. But what you can see is just that price keeps creating higher highs and higher lows. There's no low from this level to this level that is lower than the last. Okay, so price coming back, that's a mitigation. We don't have any breaker. Okay, another good example is we have a swing high here and also we have a swing low. This low right here that took out this high did not take out this low. For instance, it would have been another situation if we have a candle closing like this. So it would have been another story if what price did was to close like this or even weak this low before going to break this high, that would have been a breaker, right? That is, this bullish candle would have been a breaker. But in this case, it is a mitigation. It becomes a mitigation block because we do not have any stop hunting before price took out this high. Same thing I explained right here about mitigation, right here. So this is a selling case and this is a buying scenario. Okay, I hope that is clear. Now let's find where we can find see a very nice breakout block. Okay, if you look at my screen, and the first question I want to ask is, what can you see? Can you see the breaker? Can you see the stop hunt already? Can you see the return to breaker? All right, so let's mark it out together. First, I see this low, right? And I'll call that a sell-side liquidity, just the way I've been explaining. And then what do you see? We see that price comes deep below this low and then immediately rallied, right? Now, I'll just put a, just do this, nice. Then I'll label that as my market maker buy model in forex. But here we'll just call it a buy model. We can also call it market maker actually because it's a market and someone made the algo that delivers this price. So we have a buy model here, and a buy model that involves a turtle soup or a stop hunt of the sell side liquidity, and then followed by a market structure break. This is a market structure break. This high, that's bullish market structure break. This high was taken. This is how I actually carry out my analysis when I'm day trading. BMS, you see this on my chart a lot. Bullish market structure break. And then what happens? The last up close candle before that stop hunt becomes your breaker. And then all you have to do is to mask the entire range. Number one. Number two, mark the mean threshold or consequent encroachment, which is 50%. You really don't have to use anything to measure. You can just use the senses. Just say, okay, where can the center of this candle be? Just place it and draw it. And it is expected that I made a mistake. I'm not supposed to include the wick, just the body. And then place the, I hope my calculations are correct. Then we can expect that price would come all the way to the 50% of the entire range. Then you can take your buy. I really don't like taking my buy on the 50%. As long as price is inside this green box, I'm already taking my buy. Sometimes they would test this black candle here. That's the height. That's the best that they would do. Or should I say worst case scenario? They would test this. But trust me, in situations where you have stop hunting followed immediately by a market structure break, they really do not do deep retracement. The same thing in foreign exchange. They do not do deep retracement. If they want to do deep retracement, they don't do it like this. They don't do stop hunting and immediately they consolidate for a while. They consolidate, then they can wipe out the entire sensor liquidity, then go up. But see where you have sharp movements like this, they just sometimes I like to use fib. Take the entire range from 0 to 100 and then mark 50% equilibrium. Once price goes anywhere below 50%, it is already in discount, and then you can start buying. As you can see, it tested exactly where we marked as our middle or as our mid range of our breaker block before buying. So this was just random. Okay, I can swipe 5 times and show you another one. It happens all the time. They repeat. And you have to close your eyes to be able to see it as it forms, not after it has formed. And how can you do that? You can only do that by practicing. Spend hours just practicing, training your eyes to see breakers, training your eyes to see mitigation blocks, training your eyes to see other blocks, training your eyes to be able to use the optimum trade entry, you know. The last one we are going to look at is the fair value gap. There's a lot of traders who look at this particular trade and then they would not frame their entry around this one, that is the last up close candle before the stop hunting, or rather they will look at the entire expansion and then they find the longest candle. They find the longest candle and then that becomes their fair value gap. And in this situation, in this case, the longest candle is this one, and all you have to do is to take the candle before and the candle after, then you draw it forward. Like that. So the candle before and then the candle after, which is this one. Draw it like that. Boom. Price comes into the fair value. So this is a fair value gap. As simple as that. That is your fair value gap. So price comes into your fair value gap, and then you can now look for buy model. How do you look for buy model here? Just go to maybe 5-minute chart. You are going to see this high taken out and then another retracement into a refined order block for a buy. Trading is very simple. Just market structure and patience. Okay, just market structure and patience. Lastly, I won't advise trading this particular instrument on weekends, especially Sunday. They tend to not trend almost 70% of their instruments. They might trend one or two massively, but the question is, how would you know which one is going to trend this next weekend? They really do not like trending a whole lot of their instruments during the weekends, and if you are caught trading the one that has been selected not to trend during the weekend, then trust me, you will probably not make anything. It's best to trade it during the week. If you see your setup, take it. I'm not saying if you see your setup during the weekend, you shouldn't take it. But what I'm saying is, generally from my own experience, trading this thing on weekends, it has not really been encouraging in terms of moves and trends. Okay, so I've explained fair value gap. Let's scroll through this chart and then look for another example of fair value gap. Remember when I was teaching on discount premium, I also talked about fair value gap. Higher time frames such as weekly, daily, and how you can bring it down to frame your entries on much lower time frames. Okay, all right. This is another example of a fair value gap. You can see here we actually do not have a stop hunt. Okay, we do. As little as it seems, it is actually a stop hunt. So in this situation, price hunts this low and immediately reverses, taking out this high. That's automatically bullish market structure break, as you already know. Then the next question relies on, okay, I want to start looking for buy, but where do I look for my buy? What discount area should I start looking for? It's simple. Here, you'll probably be able to spot this last down. I will not be using this one because the wick is almost twice as long. Um, it's longer than the candle body. So I'll be using this one. So I will take it from the high of the wick to the open of the candle. Okay. So for completeness sake, we have four consecutive bearish candles. So for completeness sake, we can assume or make use of the first one, which is that one right there as your order block. Because if you go to 4 hour, if you go to 4 hour time frame, 4 hourly time frame, you are going to find out that these four candles here equals to one bearish black candle. And on such time frame, that one single bullish order block becomes one. So we are going to take the first one, and you can decide to draw this all the way to the high of the last down close candle. Another person might decide not to use that and use something else, which is the fair value gap. And from this swing low that haunted this low to this swing high, which candle forms the largest gap? It is this one right here. So I'm going to take the candle before up to the candle after. So I'll take the high of the candle before and the low of the candle after, and you can see how precise this even is, even more than using the order block. Okay, the price trades back into the fair value gap, and then look at the reaction. Okay, so you can practice this, try to find market structure and try to find premium arrays or discount arrays that is available to you, then frame your entry around that particular array that you've been able to plot, that you've been able to find. Okay, it's very simple, and it's not difficult to do. All you have to do is just practice a lot. Okay, so far we've been able to uh, treat other blocks, uh, breakers, mitigation blocks, portion blocks, trend lines, optimum trade entry, and fair value gap.